Everyone tells you renting is throwing money away. Almost nobody tells you the actual math says the opposite might be true. Here's the number that should bother you. Since 1890, US housing prices have gone up by less than 0.6% a year after inflation. Not per decade. Per year. Over more than a century. Compare that to the stock market, which has returned somewhere around 7% a year after inflation, over long stretches. That's not a small gap. That's the difference between money that barely keeps up with inflation and money that actually compounds into something. So why does everyone act like buying a house is the smartest financial move you'll ever make? Because owning a home feels like an investment. You get a monthly statement, sort of, it's called a mortgage bill, and you watch a number go down, and it feels like you're building something. But here's what that feeling hides. Most of what you're paying isn't going toward wealth. It's going toward interest, property tax, insurance, repairs, and maintenance. Costs you will never see again. Renters pay one unrecoverable cost, rent. Owners pay several, and most people don't add them up. There's a framework for this built by a portfolio manager named Felix, and it's called the 5% rule. It's not a study, it's not peer-reviewed, it's a practical framework, and it's a good one. Here's how it works. Take the value of a home, multiply it by 5%, divide by 12. That's your monthly break-even number. If you can rent a comparable place for less than that number, renting is probably the better financial decision. If rent costs more than that number, buying starts to make more sense. Where does the 5% come from? Break it into 3 pieces. 1% is property tax, money you pay every year with nothing to show for it. 1% is maintenance, the roof, the boiler, the thing that breaks the week after you move in. And 3% is the cost of capital, which so what your money could have earned somewhere else. If you took out a mortgage, that's roughly your interest rate. If you paid cash or made a down payment, that's the opportunity cost of not investing that money in the stock market instead. That last piece is the one almost nobody accounts for, and it's the biggest piece. Say you put $50,000 into a down payment. That's $50,000 that isn't sitting in an index fund, compounding at market returns. Historical data going back to 1900 shows real estate returning about 1.3% a year in real terms, globally, while stocks returned about 5.2%. That's not a rounding error. Over 30 years, that gap is the difference between a down payment that barely grew and one that could have multiplied several times over. Let's run an actual number. Say you're looking at a $500,000 home. Multiply by 5%, that's $25,000 a year in unrecoverable ownership costs. Divide by 12, just over $2,000 a month. If you can rent an equivalent home for $1,800 a month, renting wins, financially. If the only equivalent rental nearby is $2,800 a month, buying starts to look better. The 5% rule doesn't tell you what to do. It tells you what number to actually compare, instead of comparing rent to a mortgage payment, which is the wrong comparison almost everyone makes by default. Now, I want to be direct about the limits of this. This rule was built around the Canadian housing and mortgage market, and things like property tax rates, mortgage interest deductibility, and typical maintenance costs vary a lot by country. If you're in the US, the mortgage interest deduction changes the math a little. If you're somewhere with strong mortgage interest deductibility built into the tax system, the real cost of debt can be meaningfully lower than the sticker interest rate. But I'm not going to hand you a number for that here, because it depends entirely on your local tax rules, and I don't have a verified figure I trust enough to put in front of you. If that applies to you, that's homework, not something to eyeball. Here's the other thing nobody tells you. Maintenance costs are usually underestimated. The common assumption is 1% of home value per year. People who've actually owned homes for years will tell you it often runs higher. Sometimes close to double that, especially on older properties. If you're budgeting 1% and reality is closer to 2%, your break-even rent number just moved, and buying looks worse than you thought. So, does this mean renting is always better? No. And this is where the 5% rule earns its keep, because it's not dogmatic. There are real situations where buying wins even on pure financial terms. If you're planning to stay in one place for decades, the fixed nature of a mortgage payment versus rising rent starts to matter. If your local rental market is genuinely more expensive than the break-even number, buying is rational. If you're the kind of investor who won't actually put the difference into the market, if "I'll invest the savings" is a fantasy and not a habit, then the forced savings of a mortgage might be the more realistic path to building equity, even if it's not the mathematically optimal one. That last point matters more than people admit. The 5% rule assumes discipline. It assumes that if you rent and save the difference, you actually invest it every month without fail, for years. If you won't do that, if the money would just get spent, then the math shifts back toward buying, not because buying became a better investment, but because a mortgage is a commitment device and a brokerage account isn't. The point of this isn't to tell you renting is right or buying is right, it's that most people are comparing the wrong numbers. They're comparing a mortgage payment to a rent check and calling it a day. The real comparison is total unrecoverable cost versus total unrecoverable cost. And once you run that number, for a lot of people in a lot of markets, renting and investing, the difference comes out ahead, not because renting is virtuous, but because the historical return on a house has been shockingly close to zero once you strip out inflation. Before you buy your next home, or renew your next lease, run the actual number. Take the home price, multiply by 5%, divide by 12. Compare that to real rent for a comparable place. Not what you assume, not what feels right, the actual number. That's the only version of this decision that isn't guessing.